All right. So good afternoon, ladies and gentlemen, and thank you very much for joining us for the finance panel. As a Master of Finance student and a banker, this topic is obviously very close to my heart. But I think you'll be pleased to know that on the panel today, we do not have any bankers. And actually, we have panelists who reflect the fact that finance in Africa has grown up. In one of my courses, I was taught that to have a strong and stable financial system, you need professional services, you need lawyers, and you also need private equity. And these are the people who are represented on the panel today. So without further ado, I'd like to introduce Gabriel, who will be our moderator this afternoon. And Gabriel will introduce the panelists for us. And we look forward to a very good discussion. And I do expect that being a business school, we'll have some thought-provoking and difficult questions for the panel to tackle. Thank you. So Gabriel.
Good afternoon, everyone. It's great to be back in Cambridge. Luckily, I've not been away for as long as Akeem or any of the other speakers. I've only been away for just about 2 years. I was lucky to have concluded my PhD thesis in 2012, and it's happy to be back to see Cambridge. Like Dolores said, thank you very much, and thank you for inviting me also to participate in this panel. Just first, I'd like to give you a brief overview of what this panel is going to do today, and then we'll go on to the introduction of the members of the panel. A key point that has been highlighted throughout the course of today's conference has been the optimism that permeates throughout. Everyone is excited about Africa. But there are challenges, and one of the key challenges relates to access to finance. The panel today is going to try to address the question of access to finance. How do businesses and how should businesses and what are the successes of businesses accessing finance in Africa? Just to give you a direct overview there. And we have, like she rightly mentioned, we have a very good panel today that would help with that. We have people involved in investing on the equity side and those also involved in investing on the debt side of financing in Africa. I'll give each of them an opportunity to introduce themselves and tell us how they first got involved with financing in Africa. If I start from the extreme end.
Okay, my name is Beck Swawudi. I'm a managing partner, I don't know if it's still up there, maybe CBO Capital Partners. We are a GP which is based in West Africa, Lagos. I graduated from here 20 years ago when I think this building was 1 year old. And I'm trying to figure out how they keep the colors so bright and what they're doing because it's 20 years ago. I worked in finance in the city of London and moved back to Africa 9 years ago, to Nigeria. Our business raises money for smaller companies. We started 5 years ago. We've done about $200 million worth of deals. We have 20 staff. And we do deals that are smaller than the kind of things that are done by these gentlemen to my left. They're so much bigger than I am. But the key thing about our experience in Africa is actually setting up a business, finding talent, motivating teams. And the hardest thing actually, what we found, is actually finding the right targets, the right companies at the right stage. Sometimes that's the most difficult thing. So we can share some of that experience with you. And we look forward to the rest of the panel.
Thank you.
My name is Peter Myler. My career background, I started 18 years ago, 9 years with Vodafone in South Africa, 95. I didn't know what is mobile telephony when I joined. And when it was launched, and 2001, I got relocated to Tanzania, started another mobile telephony business. And throughout Vodafone, I was in finance guy. And 2004 up to 2010, I was an investment banker, both with Rand Merchant Bank and with Standard Bank. 2010 until now, I've been in private equity business. I'm with CDC. Our mandate is to invest in Africa and also in South Asia.
Farid Sejel-Massi, I'm from Algeria. I'm a partner with McKinsey. What I do most of the time now is covering our banking clients, but also our private equity clients across the continent, from Morocco, Algeria, to Kenya, Nigeria, and even South Africa. I've been with McKinsey for 10 years, and when I joined them, actually, I was mostly focused on serving banking clients in Europe. But then I met with this colleague of mine who's Moroccan, I'm Algerian, and told me, why don't we try to open an office in North Africa? So I fully embarked on this journey of setting up an office in Casablanca, which is now an office that has 50 consultants, probably like around 80 staff, from which we cover, I would say, most of the French-speaking part of Africa, so North, but also West Africa. So basically, for 5 years, I was working between Europe and North Africa, and once I became partner, I just basically let the Europe part go, and actually decided to do basically most of my work, almost 100% of my work, in North Africa, but also in Sub-Saharan Africa. Actually, my career before that, it's interesting. When I graduated from undergrad, I had a pure, I say, European US career. But at some point, my company asked me to go to Brazil. So I spent 1 year in Brazil. And I loved it so much. I loved emerging markets. And then I said, okay, let me just go back to my emerging markets. And that's how the adventure started, actually.
Thank you, everyone. I'll just give a quick introduction of myself as well. I've been lucky enough to work in Nigeria as a lawyer. Now I work in the city as a lawyer, so hopefully I'll be able to ask some questions in relation to the legal side of things. But we'll move quickly now to the set of questions. And the way we're going to go about it is I'll ask just one question and allow each member of the panel to contribute in the way they best see fit. So I'll start with the first question. The population strength of Africa has been highlighted. The need to create jobs has been highlighted. And then the need for growth to happen has also been highlighted. And there's a need for financing for SMEs and different types of organizations on the continent. As individuals and in terms of your area of specialization and things of and where you operate, what would you define as success in financing in a way that would ensure that the engine of growth goes the way it should go? What would you define as success in sourcing finance on the continent? If I would start with Farid.
Thank you. So Africa is going to grow at 5% over the next 10 years. If we look at African companies, African infrastructure, we need about 200 to 250 billion of investment every year. So obviously we need to find sources to finance these investments. Actually, a lot of it, there's different equations in different countries. I think in many countries, like my country, Algeria, like Angola, like Libya, I think the government actually will, the oil, the commodity businesses will finance a lot of these businesses. And actually, the need for intermediation will be there at some point, but now things can still work out without it. Actually, when you look most of the continent, you look at the biggest economies, South Africa, Nigeria, Morocco, Egypt. The financing of these needs will require the emergence of a strong, structured, and innovative financial sector. I think the success of this sector in the future will be obviously to cater to the investment needs and actually to cater to the needs of, I would say, these segments of the markets that are being relatively ignored, let's say SMEs, lower income populations, infrastructure. And the only way to do it is actually to be innovative. I think I would put innovation at the heart of the success of financial services in Africa. Actually, even more than in Europe or on other parts of the world. Innovation.
Yeah. Thank you very much, Farid. Peter, just to put a little twist on that question, if you could, in your way, just in giving us an overview of what you would describe as success, give us some intra-country comparisons and inter-regional comparisons as well, as you would like success to be defined. For example, what country do you think is blazing the trail in terms of development and sources of financing on the continent?
I mean, if I were to put it as a country, I think it will be a little bit of unfair. It's 55 plus countries. I like to hopefully put it on the other side and give you my practical examples that I've seen, let's say 15 years ago. 15 years ago, Vodafone raising capital into the rest of Africa operations. It was funded 100% equity, the most expensive. There was no debt. No commercial bank was willing to offer a greenfield operation in DRC or in Mozambique or in Tanzania. That's it, period. So that was expensive. It had to be funded. Then 10 years, when I moved into investment banking, I believed so much about funding telecoms because I knew that there was money to be made. But it was so difficult, even for me with my employers, to convince them to fund greenfield operations in mobile telephone. A few deals were done. But then there was a little bit of a mixture, debt and equity. For the first time, some of the businesses, they tested to have leverage. And then when I look again, 10 years, before 2005, the Chinese equipment suppliers came into Africa. People tend to say mobile telephony created Africa. For me, I keep on saying, if you were to look at the equipment suppliers that were coming from Far East, they came with more what is called vendor loan. And which before, other than Western, you had to pay 100% before even installation. They were giving you full kit installed, you repay over 3 to 5 years. There was another form of source of finance. And you look again, coming back 7 years, 5 to 7 years, emergence of private equity, also providing capital. So what it does, the source of capital and the source of capital increases, economics teaches that the cost will reduce, and which is true, cost of funding is reduced. But the challenge is that it doesn't hit to all businesses, and which Bex will talk about into the SMME, how do they benefit from that source of capital. But when I look at it now and the change going forward, from my side, the source of capital, it should not be only the traditional banking equipment suppliers. You were to look at the sovereign wealth funds of Africa, you look at the pension funds of Africa, they are sitting on capital. And where is that capital being deployed? On government bonds, yielding nothing. So immediately, if there could be a reform, either there could be diverse debt, other than going into fixed income or listed equities. Some of the African countries, they've got almost around 8 to 10 counters, which I call them BBC. It's either a bank, brewery, and cement. That is the stock market, that's it. And it doesn't move, it's buy and hold. If they could be able to divest that to unlisted companies, which your clients will benefit, that's another point. Secondly, if that capital can also be deployed into neighboring countries, you hear all this story, African problems can be solved by Africans, and which is true. So why shouldn't Kenyan pension fund invest in Malawi and Malawian pension fund invest in Zambia? Immediately there's more sources of capital. So we can think about other traditional or how do we do this, structure is the MES, this instrument and that way. But some of the things, they are actually at home. And why I present this as an opportunity for us is because I believe I'm speaking with the future ministries of finance here, that when you go back home, please be able to make proper influences to enable that capital to be deployed in proper businesses than rely on the traditional method of capital.
Thank you very much, Bex.
I completely agree with both the points made. They covered most of them. I think that to add to that, I'd say that the African capital system, recycling system is incomplete. There are many, many gaps. There's limited venture capital. There's barely any unbloodline-related angel investing. There's, and there are gaps all over the place. You haven't got buyout funds. You haven't got all kinds of things. That's the big opportunity for us as we see it. If you look at how much the pension funds actually recycle into their own economies, I mean, Peter was being kind, saying that they've got about sort of 70, 80% in bonds that the government's using to do all kinds of strange things. Instead of actually putting that money into new sectors, private equity, infrastructure that they need themselves. Now, taking Nigeria is a funny example because Nigeria has a lot of money, but it just just sort of is difficult to get hold of. It's like a slippery little snake. The funny thing about, say, Nigeria is it recently privatized its power sector. And the local banks, which were still quite young in terms of age, but had grown rapidly in size, were the reason why that privatization was a success. It was one of the largest privatizations that had ever taken place of any country privatizing all its assets in one go. And it required something in the region of between $3 and $5 billion of financing. And they financed it, and it happened. And people don't really talk about that, but if you didn't have the indigenous banking sector to do that, it wouldn't have worked. It just wouldn't have happened. So policies and the kind of things that are being done to improve the quality of the financial sector are coming, but it's a little bit slow. We just need to work on the pension funds to do the same thing. Give you an example of the sizes of the pension funds industry. I'll compare Nigeria to South Africa. In Nigeria, the Pensions Act was passed in about 2003. We have $25 billion saved in the pension system. These are forced savings for people's retirement versus, okay, I'll use the new GDP of 510 billion. That's 5%. If you turn to somewhere like South Africa, you've got savings near $500 billion versus a GDP of 350. So they're north of 100%. So South Africa has passed laws now to actually start pushing more capital into the rest of Africa ex-South Africa. So they're looking at the opportunity. Hence, you'll see ShopRite moving into the region, the Public Investment Corp investing in Dangote, investing in EcoBank. So you're beginning to see the beginnings of some of that intra-Africa investing, which I class as success. When Africa starts funding itself, that's when it's successful.
Thank you very much. So essentially, as a kind of summary, success will involve diversification of the sources of funds, innovation in the approach taken to funding, reducing the restrictions that are currently in place for intra-African financing. But in terms of your engagement on the continent, what challenges have you been involved in, and what challenges have you seen, the greatest challenges in terms of investment and sourcing financing for SMEs and other organizations on the continent? This time, if I'll start with Peter.
I'll put it now put on my head as a private equity investor. You look at it in terms of you put in capital into a business, any business. The first challenge you find that is there is a huge mismatch between what the company itself receives financing from, let's say, a local bank. So the local bank will come and say, okay, we'll give you a 3-year capital, and what is the money is going to be used for? Is going to finance expansion, greenfield plant. It will take 2 years to be able to build that plant, year 3 to 5, ramp up. But the bank is demanding that within those 2 years, nothing has been produced, interest, capital must be repaid. So those are the mismatch that you find that the banks need to be educated. That's one part. The other part, you are looking at it to say, the private equity as an investor, what are the challenges we face? It has nothing to do with capital. So you find that you want to deploy capital, but the challenges that you face, some of them beyond regulatory and legal, we can go deeper about that. But you find with the entrepreneur, you sit down with the entrepreneur and say, okay, you'll negotiate price and valuation. But post-investment, as a private equity investor, I'm going to be sitting on the board, I'm going to participate in strategic decision, hiring of new staff and all that. From the promoter or the entrepreneur, he's looking at private equity as another form of capital from a non-bank. So post-investment, these are the challenges. So you step in, you start asking for information. He said, why do you need information? Even the bank doesn't ask me information. Why do you have to be on the board? And those are the challenges then, because when you invested with a particular investment thesis. You wanted to take this company to grow it, to expand to ABC. You start dressing up for sale so that when I exit, the company has grown from 1 to 5, so I can get you a 3x money return. So those are what I call the operational. First of all, we found with a simple promoter to be able to educate them, because private equity to them is still something new. The word EBITDA, it doesn't exist to a normal accountant in their firm. So for us, when we go and say, okay, give me key performance indicators, I want to see this per revenue, this per EBITDA and all that. It's totally new. So those are the challenges when I'm talking from private equity investor. There are a lot of challenges, but there are multiple solutions on it. So some of them, when I talk to my private equity investor, professional peers, I said, we need to educate the promoters. How life is going to change post-investment. This is our strategy. By year 1 to year 5, we'd like to see the following things happen. Are we in agreement beyond the price and valuation?
Farid, in answering the question, if you could just touch on regulatory, legal, if possible, for members of the audience, challenges that you may have faced in the course of your experience on the continent.
Thank you. Again, one of the key challenges will be doing business, the simple, I think all what our keynote speaker mentioned earlier. But let me not touch on these because I think these are, you have a lot of literature on them. I want to discuss two or three challenges that I saw my clients grasping with in Africa. I would say the first one is regulatory frameworks and infrastructure. And I give a few examples. Africa has, there's a housing shortage in most of African countries, and actually housing finance has been on the agenda has been on the development agenda for many years now. And both governments, central banks are trying to develop it. But when you try to dig deeper and understand what are some of the hurdles that actually players like banks are facing to develop this, many of them are actually regulation. So you would tell me, if these challenges are clearly identified, why don't the regulators simply change the regulation and makes housing finance possible? Just an example of regulation that is a problem in this case. There is just so much of your bank deposits that you can transform into long-term maturities, which is actually the right type of resources you need to loan mortgages. So if you go to more developed banking sectors, this ratio can be up to 70-75%. In most African countries, it's actually 25%. So only 25% of your deposits can be transformed into long-term maturity loans. So many banks will go to regulators and tell them, not allowing us to transform more than 25% is actually limiting the amount of housing finance that we're able to provide. And the discussion has been going on for a decade, I would say. So changing regulation is not always easy because it takes mature regulator, it takes mature players, it takes competence to be able to have the proper discussion. So I think this has been at the core of moving, I would say, the financial sector forward. Other aspect I would call infrastructure. For a bank, for financial services company to operate well, you need some good infrastructure around you. And the capital market is an infrastructure. Being able to borrow, borrow long-term, long-term maturity is also an infrastructure. But it's also having, a good court, good lawyers, is part of the infrastructure. I think this has been actually, although it's improving a lot, has been a hurdle. I think in the next 5 to 10 years, there has been so much focus in developing the infrastructure that a lot of things will change. But right now, it's still a problem. Let me touch on to another issue, what I would call making things local. And everyone has heard of M-Pesa. It's a huge success story in Kenya. And one would ask, why M-Pesa doesn't exist in Nigeria? I mean, it's an African country, it should be easy. We just take the model that exists there, you take it, you put. I'm taking the Nigeria example, but you can take pretty much almost every other African country. And this is actually, I think it's at the core of the innovation. How do you take a model that works elsewhere, even in a country that could be your neighbor, bring it to your country and kind of adapt it? Because you have a different industry structure. In Kenya, one mobile operator is very big, which actually made it easier to develop, this business. In other countries, it's not the case. The balance of power between, let's say, telcos and banks, all kind of regulations. So how can we actually learn to innovate locally, even if we're leveraging, say, global knowledge. And I have the last one, but
Before you answer the question, Bex, I'll just thank you for giving us the space. But before you answer the question, I'd just like you to also, discuss on how you've approached some of these challenges and your experiences. So outside addressing some of these challenges and highlighting them, just give us an idea of how you've addressed them in some of the transactions that you've been engaged in on the continent.
Okay, so if you say start with the challenge of a weak legal system, it's a really funny thing to sort of think about theoretically and then sort of experience practically. It's one of the things you sort of laugh about and sort of think, weak legal system doesn't really matter. But you can't actually enforce any of your rights. You can't protect the things that you develop. You can't, your employees can leave tomorrow and set up a business that means the same thing, and you've invested in that person and there's no comeback. So what we find actually with that, and by the way, the name actually of our company means challenges bring opportunities. That's CBO, that's what we actually do. So we always see that, or we always see opportunity in every challenge. But the key thing is, and how we've dealt with that, is that you really must, on the first hand, work with, it's all about people that you work with. If you rely on a legal contract to protect you in Africa, you're in a big problem. It's not a very good place to start. And I wouldn't, it's odd when we talk to some of our investors, we actually sort of say that they tend to like very long legal documents. And so if you want to do it properly, you're going to need a 200-300 page legal document or set of documents. Now, if you know that the person that you're negotiating with isn't going to read this third iteration of that document, they're not going to read it. And if you put something on page 100 that they don't like, then ultimately you're being a little bit dishonest in actually putting it on page 100. It's better that you have a 20-page agreement that everyone reads, and then you have a page of exceptions at the back so that, okay, if this happens, we'll manage it. There's an African we'll just kind of find a way of working together. Because what tends to happen is if you find something in the legal system or in the legal documents on page 150 and a highly aggressive lawyer comes along and says, we're going to enforce this. And the local African dude turns around and says, I will show you. You are not here. Not here. Nothing could go wrong. So things like that, you've got to try and adjust the business. There are challenges. That limits the kinds of risks that you can take up front in terms of capital. But I think the biggest challenge, again, is solved by people. And the biggest challenge is people. It's finding people with a particular combination of skills. It's people who are extremely intelligent, hardworking, but team players and long-term. That is almost impossible to find. No matter how you incentivize, no matter how you align, it's very, very difficult. So most people want to come through the system, sort of learn from you for 2-3 years. They haven't really learned everything, then they want to leave. Or if you've got a business, they want to sort of sit in that business for a couple of years, then they want to leave. And that's why you'll find a lot of family-owned businesses. That's why it's family-owned. They want their family to be around. They want those ones to understand the business and stay with that business. So finding the right people is a challenge. So I think, and also I'm a returnee. I was born in the UK. I'm Nigerian. But when you go back, you've got to realize you've really got to sort of go back to the bottom rung and just really try and understand how the society works, how the connections work, and what your role is within. Be honest about what your role is within that society. Are you a brain? Are you, what is it, like finders, minders, grinders, right? Are you like a brain? Are you a connector? What's your role? And play that role and look for people who are good at the other roles that you don't have, that you can fill in. Because right now, there is a whole class of people at Lagos Business School, at some other business school, becoming friends. And they will do business in ways that you can't imagine because they're friends. They know each other. And when you come into that room with all your grammar and all the English, they're looking at you like, is this person serious? They're gonna hammer this person. So you've really got to find ways past that to actually build bridges, work together, and find those people who want to be team players, who want to build win-wins, who'd rather have, 50% of 500 rather than 100% of 20. And you've got a lot of people in Africa who want 100% of 20 because they can control that 20 and they can go to sleep at night. And they don't pay for insurance, they pay their pastor who makes them happy. That's going to change, but those are some of the challenges that you face.
Thank you very much. But I think I hold myself an obligation, and I owe this audience an obligation to clarify at least a few legal issues. The African, the African legal system is not as, it's not as difficult as it appears from afar. In fact, it's a relic of the colonial system. We operate a common law system with a bit of traditional input. So to say that an agreement in Nigeria cannot be upheld would not be true, or if you say the same thing in Ghana, would not be true. But what you need to do is ensure that you have
Timing issue. I'm saying it's
no. I totally agree with. I totally agree with the point that you made on having the right team, and that right team includes the right lawyers. You must go there. You must no. So you must.
You forgot to mention the lawyer that knows the judge, not the law.
Oh well. Yeah. So going the team. One point I've gotten from. You're right there, but when you're good again, merit is not totally neglected as well. There's a place for merit in the system, and a team has to comprise of a very good lawyer. So please, when you're trying to explore the continent, of course, I'm sure everyone here knows that you need to go there with your lawyers from the start, not from the middle of it, where you enter into a concession agreement that basically changes you, and then you're trying to bring in the lawyers in the middle of a transaction. Nothing can be changed at that point. Or you want a document to be binding on the country, and the document is being signed by the vice president and not the president. The next government is going to say, no, it wasn't properly executed. So there are tiny, minute details that you need to look out for, and only your lawyers will be able to do that for you. But I'll move on to the next point. So the final point I'd like to ask the panel is, in terms of the future, how do you see financing on the continent being developed? And how would you prefer that it develops? In one of the earlier sessions, we heard about a scheme in, was it Kenya, where the government makes room for SME funds and then creates opportunities for those SME companies to execute those. Is that going to work in all African countries? Should there be other models? What do you define as the next phase in financing on the continent? This time I'll start with you again, Bex.
I mean, just to give you an example about some of the companies that we deal with, I mean, and one of the issues that we face, one of the issues and opportunities that we face is that everything's an opportunity. Everything. We import healthcare. We import education. We import food. There are no roads. The internet's slower than here, I suppose. TV's okay, getting better. So the problem is just an embarrassment of opportunity. It's just too much out there. The key thing to do is to focus. And I think that's going to be the most important thing. And how the financial markets, we expect them to develop, will be driven by that focus. For example, there's a company that I met, founded by three guys in 2002. And they were going into oil services. So this is a funny one. 3 people, SME, I think they've got 100 staff. At one stage in the company life, I think in 2006, they were making so little money that one of the founders had to borrow money from the other founder's wife to actually pay his kids' school fees. Yeah? They're really struggling. But what they do is they manage what they call ROVs. And ROVs are vehicles that actually sit at the bottom of the ocean when you actually start looking at oil blocks and stuff like that. And each ROV costs $6 to $8 million. They've got 8 of them. They recently bought an extremely large ship that cost $100 million, and their revenues this year are north of 80. There's no borrowing money from wife anymore for school fees. They're liquid and rich. That shows that the local content ambitions of Africans can be funded, and they're funded by a local bank. But that's local opportunity, services, local firm providing that service, local bank funding that, local equity, local pension funds, and then the system works because there's no leakage or not too much leakage of value throughout the system. If your pension funds don't participate, then you become relatively poorer, even though your country becomes richer because your pension fund didn't maintain pace. So the house next door you can't afford because it's gone up 10 times, your pension's gone up once. The key thing is, I'd like, from speaking from my own position, we'd like to see much more local funds. I mean, we come from Nigeria. Nigeria's a rich country. There was an argument about the central banker saying, well, have you misplaced $10 billion? Where's it gone? Oh my God, it's under my chair. These sorts of things. So we have a lot of cash, but we don't recycle it well, we don't direct it well. We'd like to see that improved, and if that gets improved, stories like the one I gave about that particular company that's grown from nothing to that size are the reason why we're in the business that I'm in, because those opportunities abound. And to participate in those opportunities as an entrepreneur, as an employee, as somebody that wants to invest is a great joy, because we get to both make money and also have an impact, because really money isn't the driver for what we actually do. It sounds odd, I say that to investors, they get a bit freaked out. But you know, it's kind of like, look, I don't work the hours that I work just for cash. I work the hours that I work because I don't like the fact that the tallest building in the country is 25 stories. I don't like the fact that my wife and I go on date nights. We run out of restaurants after 10 weeks. I don't like the fact that, you know, at the age of 11, my kids' school is touch and go, that age. You know, good before, bad after, and really expensive. You know, I don't like those things. So by impacting and changing society, you're actually improving the lives of people whilst recycling capital. Remember, half the profits that we make will end up in the pensioners' hands anyway. So that's why we do what we do.
Thank you very much. Peter, if you would take the floor.
I just wanted to touch something very close, personally for me, which is health, the health sector. You had the stats saying 18 years the average age of Africans. And my question for that is, what is the lifespan of an African? For me, I'm an entrepreneur. When I wear my hat as a businessman, I like my customer to be able to live long, so I can make money long out of him. That's fair. So now, health is a challenge. And you look at Africa, you were to look at India versus Africa. This is when I started doing business in India to see the comparison. India produces thousands of medical professionals a year. Africa, on the other side, very limited. So when I have a discussion with all major health operators globally, come, let's go to do business in Africa. They said, yes, we'd like to go to Africa. I said, why? They said, we can see the numbers of Africans flying into India, flying into South Africa, flying to Europe, and they come over here because if you were to look at it, they pay for the flight ticket, for the hotel accommodation, and Africans, they are large families. So one granny is sick based in London, there'll be around 10 of them. So they've booked all over the place. So it's not a problem of finance. I wish one day we don't have to discuss that there is a problem of finance in Africa. Problem in Africa is not finance. African consumer spends very well. ShopRite is similar to Tesco in South Africa. Let me put it that way. In South Africa, they don't even sell champagne, expensive champagnes. But into the rest of Africa, they make more sales of champagnes than even in their local market. So the consumer is not a problem. Money is there, both from the consumer and investors. My peers in private equity, they're looking for opportunities. Sovereign wealth fund, they're looking for opportunities. Health operators, they want to open business in African countries. These are the challenges. And I go back. I believe I'm talking with future leaders. You will go back home and change this for me, please. One, when you look at it, you ask any large health operator, open a hospital. So, okay, it's fine, we'll open it, but we need to employ doctors. When you open a hospital, you need almost around 20 to 25 specialties, different from gynecology and all that. But regulation says you have to employ local people, and they are not available, so they cannot do anything. Then I speak with the health ministers. I say, what if they were to open a hospital and provide a nursing college and medical staff so that local people can be trained? Wouldn't that be better? Yeah, it will be better, but I want them to employ local people. I said, there's no problem. And I can take any other country. I don't like mentioning countries. There are some of the countries you could look at it, you go back, they've been having civil wars for 30 to 40 years. So effectively, locally, there haven't been people who went to formal education. So there is no way, even if this is what you desire. I understand you desire because of the flag. But the message that from my side, that like for us, what we do is we interact. You look at a sector, sit down and discuss it with the relevant authority to say, if we're to be able to unlock this, people will invest in that hospital, they will build it, they will bring foreigners, they will train the locals, and after 10 years, you will have medical professionals in the country. And the lifespan of Africans now, instead of certain countries deteriorating to 50 to 40, then it could be increasing to 60 to 80. So those are the things that I'm looking and said, they are challenges. Then the problem there is not capital. The problem, what I call is local, that if we're to be able to unlock those issues, something could be great to be done within our continent.
Thank you, Peter. Farid, if you take the floor now.
The opportunity is massive. Just a few numbers. If you look at the banking sectors and the insurance sector, actually, there will be more growth. Not more. There'll be as much growth in Africa in dollar terms, in terms of billions, than it's in Europe in the next 10 years, in dollar terms. Going from a much smaller base, much higher growth. In dollar terms, we're going to generate almost as much extra revenues or extra opportunity for these industries in Africa than in all of Western Europe. I think that's a number that really strikes a lot of people. Basically, if you're thinking about your future, look at how many people are competing for the opportunities in Europe. Look at how many people are competing for the opportunities in Africa. And actually the set of opportunities is the same, assuming that the growth is the opportunity. So I think this is just to set the background. I think some of the challenges, and I would have a less bullish note here, I think is to avoid the herd behavior. You need to think about how to do things differently, whether as starting your own business, but even if you join an established business, because this is how you will actually make a difference and capture the opportunity. Just to give you two examples, these are clients I worked with. One is in Senegal. It's a greenfield Islamic bank, and I think they want to focus mostly on, say, the greenfield. They're small, obviously, so they're focusing on smaller clients, so I say SMEs or small enterprises. And these guys, I think, really amazing. They developed this. Sometimes the problem to lend to SMEs is how to evaluate the risk. These guys, they don't have balance sheets. Their accounts are not audited. There's no difference between the pocket of the owner and the pocket of and the business. You have so many problems. And they actually developed this model to evaluate the risk, which I thought was very innovative and very, very local. It's actually a traditional version of social networks. So what they do basically, they go into the, in Senegal you have 3-4 big religious confréries, I don't know say in English, fraternities, and what they ask for 3-4 people from the same fraternity to say, okay, this guy is a good guy, he's a serious guy. Then, frankly, looking at the business, they don't. If they know, but if 3-4 people will sign up for this guy, then the risk levels will be low. And actually, they had a lot of problems discussing with the central bank because this is not a traditional way of approaching risk, and it took actually a lot of effort, actually still an ongoing discussion to make sure that the regulation actually follows. So I think these are the kinds of inspiring stories. So there's the opportunity. If you put innovation in there, you can create truly inspiring businesses. Another example of I think SMEs is a big opportunities. So if I look at private equity, interesting part, if you look, Africa, the private equity market in Africa is still small. If you compare it to India, you have the same population, more or less, actually the same GDP in total. But private equity market in India is 5 times as big as the Africa private equity market. Private equity market will grow in Africa, most countries, most regions. But what you see right now, you see this this phenomenon where you have actually a lot of capital that is investable in private equity in Africa. But what you look at a lot of private equity investors looking at the same opportunities. You're looking at large opportunities in Nigeria, in South Africa, in Kenya, and what's happened in India is actually starting to happen in Africa. Valuation levels go up. You can expect from a lot of the players the returns won't be there, and that's what I call the herd behavior. In the financial sector, if everyone does the same thing, you create bubbles, you deteriorate returns, and actually instead of having a nice growth trajectory, you start going, going through a roller coaster. And I think knowing how to manage this kind of dynamics as as an individual investor or as a regulator will be key to having a nice sustained growth on the continent.
Thank you very much, Farid. I don't know if we have time to go on or we should move on to questions now. We should just thank our panel, but before we go, definitely we're going to entertain some questions, and we're going to take them in rounds of 3. Luckily, I also have a question, so that will be involved in one of those questions. But we'll take one from each aisle. So the gentleman in white shirt, please introduce yourself and go on to ask your question.
My name is Dukbo Salimano. There's a very interesting phenomenon in Nigeria, which is the country that I come from, and I'll be curious to hear what your take is on this. The federal government, most of the banks can get 16% yields loaning money to the federal government. Now, an entrepreneur that goes to a bank in Nigeria has to compete essentially with his own federal government. And so banks end up giving money to entrepreneurs at rates of in the high 20s sometimes. So how is this structural deformity where the federal government is crowding out entrepreneurs in that market? What are some of your thoughts on how to correct this deformity?
Thank you very much, Dukbo. We'll take the lady in front here.
My name is Sakina. It's really interesting hearing about the opportunities that investors can gain from the continent. But what I haven't found really being touched on is the exit options for investors. So the stock markets in the continent, in different South Africa's stock market is probably the most developed. But when we look at Nigeria, Kenya, they don't have as much of a capitalization as we would expect. And so the exit options for many investors, for example, through IPOs, aren't, as beneficial, or, because the stock exchanges aren't really as developed as they should be. So when people have invested in companies, how are they assured that they can recoup their investments? What kind of options do they have in those respects?
Thank you very much, Sakina. And the gentleman in front on the third aisle. Yeah.
As I saw that this was an emptier aisle, I thought I must be the proxy for this aisle. The name is Vijay, Acorn Capital. I've been trying to raise what I call funding for greenfield site agricultural development in Ghana. And I've also done similar kind of efforts for Ethiopia. And what I found is that apart from the African factors and all other things that people mention, it's also a greenfield site, and even seed capital for this is so hard to come by. But there are a couple of now DFIs, like the BIO fund and all that, who are beginning to look into it. And I think IFC is looking into it. But I wanted to see whether there is a private equity trying to build a pipeline of deals for what I call the seed capital for development of, say, agriculture or other businesses.
Thank you. I would go with those first set of questions, but I'd just like to add to what BJ just said. A key point that has been reiterated throughout the course of this conference is go through the path that is less trodden. Do something unique. How can someone who's trying to do something unique, greenfield, get finance? What would he need to show to, to you guys for you to finance his business idea? So the first question, let's just take that as the first question. Finance and greenfield projects. Are there things in the pipeline? Let's start with Peter on this point.
Okay. I'll be given conscious of time. Vijay, let's talk afterwards. CDC, we do finance greenfield operations, and we have done agriculture. Mupungwe Farm, largest farm in Zambia, was started by CDC, and we've invested in Feronia palm oil operation in DRC. Last year, toughest jurisdiction. We do look at them. What are the ingredients for successful raising funding for a greenfield? We have to look at everything. you have to be definitely come prepared with your business plan, opportunity, and all those things. I don't want to bore you with, but it has to be everything to a bulletproof, closer to bulletproof. If it's still an idea, a lot of people, they've got idea, but you find that when you start drilling in terms of the operations, it depends who you're going to meet. So for me, I've built a greenfield in Tanzania. If you can tell me that, now you'll build this plant within 3 months, I will tell you that it takes 6 months to ship something from China to landlocked country in Zambia. So how are you going to do it? You're not going to meet the timeline. But people will find that they are so aggressive instead of being realistic on their plans. So immediately you'll defend one. Then I start asking you a lot of other questions. Simple thing. This is not Michael Porter's competitive advantage and everything. It's just simple operational. How are you going to move this from here to there? And you don't have the answer there. And you can imagine any investment professional, they're meeting a lot of opportunities. 3, 4, 5 issues, I don't have a clear answer, I'm sorry. I'll have to just say, next one. While I'm here, can I just jump to exit?
Please, go ahead.
I mean, this is the hit spot on. Private equity capital in emerging markets, not only in Africa, even in India, is stuck because of exit options. Very few exits. So you were to look at US or developed market. In US, my peers in US, they buy a company, by day one, 100-day plan includes exit. To say actually, when can we start actually roadshow this company to sell? Within 100-day plan. So by that time, within a year, they're already engaging another investment banker to sell it. By year 3, the business is out. Very simple is liquidity. So you come back to Africa, liquidity is scarce. So when I was in Tanzania, 2001, 2004, I wanted to play the stock market, only around BBC, even by then, even today. So there is nothing much you could be able to do. Now, for you as a private equity investor, then it changes the dynamic how you invest. Self-liquidating instrument. I could be able to go in, structure an instrument to say, I need my capital back by year 5. The other one is an upside, or how you do it within the company. But most of the exit in our markets, you will see them, they will be going to the strategic. And it goes back what I mentioned, the challenge in private equity investment. For me as a private equity investor, I already know that a strategic coming in, they'll be looking for red carpet and all that, branding and all those issues. Immediately you discuss with the promoter, let's brand the company, let's spend money on advertising to build a brand. And they said, no, it's a waste of money. If you want to increase sales, I'll give them a discount. So the branding, an entrepreneur doesn't understand what is branding. What is it important to have a website or internet, sales, strategies? That is not in their mind. For their mind is to manufacture, produce, and they're happy about it. So when you start going in to build, to dress up the company for exit to a strategic, then it becomes those are the issues that immediately before even doing the deal, going into with a promoter, sit down with him and said, I would like to make money. The only way I could be able to exit, strategic, I could be able to get this price. IPO doesn't exist unless it's a self-liquidating instrument. If I have to sell it to another financial investor, there must be room left for growth. And I cannot ride this up to the peak and the financial investor look at it, so there is limited growth going forward. So they are also looking for growth. So either I'm on the J curve, I'm in year 1, year 2 while it's still hot, and I can flip it to another financial investor. So those are the discussions with the sponsor. You have to, prior even paying him, explain to him, this is my desire, I want to exit up to that point. Yeah. So.
Thanks, Mr. Farid. I don't know if you want to add anything to what Peter just said on those 2 points.
Very briefly, I think on the greenfield investment, I think it's all about the team and say the operational experience of the team. The risks with greenfield are always so big. No matter how you look at the problem, I think the best insurance you can get is to have a team that's really that has basically first-hand experience and preferably locally and preferably 10 years plus. 10 years. I think that's the. But that comes back to the point. I think also the point of crowding out. There's crowding out at every level, and unfortunately, in Africa right now, still entrepreneurs, SMEs are still last in the pecking order. So in Nigeria, yes, you have the federal government, but if you go in any market, large corporations actually, there's just not enough capital within banks, for instance, to actually serve the SME segments as well as they should. So the crowding out effect happens everywhere. So again, there's a lot of capital going into PE in Africa, and a lot of people, actually, lots of LPs, whether actually local but also international LPs, willing to invest in Africa. Actually, more money that wants to go to Africa than opportunities you can find in Africa. But right now, I think nobody in the continent, or at least at scale, has cracked the code to invest with the right model, with the right scale, with the right economics into the smaller opportunities. I think agriculture is probably one of the few ones that you have a lot of examples of greenfield investment that are happening. Let me also on the capital markets. Capital markets are very difficult to develop. I mean, I think there's this myth that you just need to create a stock exchange, because it runs deep into the governance of the capitalism. First, going into capital markets has impact on control. To have a successful capital market, you have to have liquidity, which means a large chunk of companies are actually listed. You need governments to issue bonds on a regular basis to create to have the transparency on the pricing. You need obviously a great governance of the stock exchange. There's so many parameters that you need to get right to develop capital markets. It never happens in 5 years. If you look at, I think Asia is a great example for this. It took them, the journey to develop capital markets in Asia started basically in the 70s. And seriously, it's only in the 2000s that they're starting to get it right. It just takes a lot of time because it's a complicated ecosystem. I think in Africa, it's ridiculous that every country wants to have its stock exchange. It's interesting, in many emerging markets, I think it's now in Asia they understood, if you look at Southeast Asia, they make the stock market as kind of something that's it has to be national. And actually I think the best thing to do is to better integrate the markets. I think that because you need scale, you need a scale from people who come and get money. You need scale from the investment side. You need scale on the people who operate IT investments. You need basically to integrate better. It doesn't mean that you don't have a capital stock exchange in many cities, but you just have to make all these guys work better together. It's easy to say, very difficult to do. But I think that's the only way forward if we want to accelerate this. Otherwise, it will take another 20 years.
Thanks, Rory.
I'll be quick.
Yes, please.
Yeah, very quick. Okay, so to the greenfield, we tend to prefer brownfield. We've actually bought listed agricultural business, and we roll into that business what we call captive agricultural development projects. That project must be captive. It must have offtake sorted out. If the offtake's sorted out, we'll give you money. That's fine. Yeah, but that's got to be hard offtake from somebody who's blue chip and credit worthy. So that's how we do that. That's in agriculture. Then on exits, there's a very good report that was written by Ernst & Young and AVCA about African exits, and that's actually the title of the report. African exits are rising. They're quite varied. What you're doing is you're finding a lot to corporates, very few to IPOs. We've done 6 exits already. We've invested 49. We have got no problem exiting a deal. We'll exit through the side window of this room if we could. There's no problem exiting deals because there's money around, and if you have the right price, you can get out. In terms of all that value add that you do, this is the thing about the character of the people. This thing about, do they want you to actually go and get proper accounts done? Are they still in the mindset that they want to be able to fly business class and use up cash in all kinds of funny ways? And that's part of the evaluation process for us, actually, of entrepreneurs. It's those tests, because we put in money into tranches. 1 month we might put in less money. We're meant to put in, $750,000, we put in 300. And to take a look at the entrepreneur and see what it does, or she does. Does she pay herself first? Does she pay the staff first? Does she go on holiday? Does she freak out? Does she not answer calls? And it's the character of the person that's very, very important. How do they operate under pressure? It's got to be tested. It's an environment where you've got to see how they actually react to certain tests before you actually then go and commit to larger tests. Because it's when you're under strain that you actually can see the character of that person and what they're doing. Exits are available. The big PE guys are actually getting huge concentrations of capital. So I came in from New York yesterday. We met a lot of pension funds in the States. The average, it's hilarious, the average pension fund in the States probably has $150 billion. The average pension fund in Nigeria has the same figure, but it was in Naira. Right? So it was like, dude, so these guys' minimum tickets are $200 to $500 million. They cannot write a ticket to my fund. And so we have like funny exchanges saying, so why are you taking my card? He said, you can't give me money. I'm too small for you to get money. To get money from you. And he said, no, you're a nice guy, so I just want to hang out anyway. Okay, we play some golf, and when you get big enough, it will happen. So what's happening now is that money, those big tickets, are going into the big funds. So you've got the big sort of Pan-African or emerging market funds. You've got DMC, you've got Actis, you've got ECP, you've got ACA, Helios, Abraj, all the big Carlyle coming. And what they're doing is they are running very similar strategies, sort of CDC, my God, Jesus, you're here. God, fucking hell, you're here, man. But your government, yeah. This is a DFI. Yeah, it's like DFI, yeah, and the other DFI is fine, shit. So we do deals. And they're running similar strategies, and that's what's pushing the prices up in that space. That is fantastic for me. That is fantastic for me. They've got a 5-year investment period. That gives me a 5-year window to put my money to work, build up that company, get it ready, because they're going to be desperate to invest that money in 5 years. So these guys, these are my exits. So exits for me aren't a problem.
I don't know if you'd also like to touch on the fiscal policy point and structure.
Oh man, fiscal policy of Nigeria. Why are we bringing this silly thing into this place? These guys. The Nigerian government borrows at 16%. I had a banker recently call me up really excited and say, you're one of our best customers. We've seen how much money you put through the account. We like the company. We want to give you a mortgage. Do you want to buy a house? We want to give you a mortgage, right? And I said, oh, okay, what kind of pricing? You're a top customer. We're going to give you one of our best prices. Okay, so what is it? It's going to be the best price. What is it? Okay, 22%. What about I just save money and buy a house if I want to do it? 5 years, I pay the whole thing off? So they're selling broken products. Some people don't realize it, and they dress it up as something different, that it's a mispricing, that it's a high yield, this, that. But the actual product's broken. If you try and sell a flat screen television where the screen doesn't work, you would say that product doesn't work, right? If you sell an insurance product that never pays out, then you wonder why your penetration's 1%. It doesn't work, the product doesn't work, they don't trust you. Or you sell a mortgage that's got 100% interest. The product fundamentally is broken. What's going to happen is that guys like, the big guys like Prudential and such are going to come in with a longer-term horizon, longer-term windows, and start actually selling products that do work and combined products that work. So it might be a rent-to-buy product, it might be a 20 or 15-year mortgage and stuff like that, and that will really change the market. So things will change. The government forcing us, that's a fiscal question. And personally, I think that they need to borrow less. There's no reason why they should be paying so much for T-bills and for these things. And it was a period of time where interest rates did come down to 7% because we started saving money in Nigeria. At the moment, we have a problem saving money, so it's a problem.
Let me just add one thing. Yeah. I think the interesting part also is that government, large parts of banks' deposits are actually government deposits. So government is putting money and then borrowing money, actually de facto creating, this is changing from a regulation, creating the de facto rent for the sector. So interestingly enough, if you look at the history of the banking sector in Nigeria, I think they tried basically to keep the banks alive by doing this. Otherwise, the banks would have collapsed. So I think it was a conscious effort also to kind of give them money basically for doing nothing. I think what they should do now basically should basically, take all this rent out, but they have to do it. They have to do it in a way that obviously it will be disruptive for the business, but they have to do it in a way that will not jeopardize, I would say, the financial solidity. But they clearly have to have. I think they have it, by the way, like a roadmap that in 5 years this thing will basically disappear. The only way going forward to kind of address this issue fundamentally is to develop the deposit base. That's the only. Basically, Nigerians have to basically start trusting the banking sector. When I say Nigerians, like 40 or 50% of population, and putting their money in the bank. I think once this happens, there will be enough basically assets to finance more than the government. I think that's the key. And again, it will take time.
Thank you very much for
But
it.
can I just add something? 10 years ago, I used to have Afro. And then I started looking at buying banks in Nigeria for 51% control for the major foreign bankers to own. And I lost all my hair. And this is the issue, to be realistically, why you could look at the Nigerian banks, very few or one or two or three are owned, especially retail bank, corporate and retail bank, that they can collect deposits. None is owned by a foreign institution. And that there is a blockage in terms of all of the foreign banks, they want to get 51%. It's so hard. It's not about price. It's so hard regulatory, even the competitors within the bank. They say, no, you cannot sell 51%. Because what is going to happen? A foreigner knows that he cannot get free cheap money from the government deposits. So he must go and pick it up from the deposits. And immediately, if any bank were to do that, what's going to happen? He will have far much better financing. He will offer you a better mortgage finance and all those issues. So you were to look at it, Kenya, for example, compared to Nigerian economy, it's cheaper to get mortgage finance in Kenya because the Kenyan banking system and the market, banks are chasing deposits. They are not chasing the government treasury bonds. So, but it's an evolution. Everyone said it will change over time. It's an evolution. You look at UK banking market in the 80s and the 70s. It was very difficult for people to obtain finance because it was tightly held, the banking system. When the American banks came over, things started to change. When the euro became more, I'll call it one zone, you could be able to get money from either in Italy and use it in UK. All those things, what it does, it breaks the system. It's a system that for now, it could be protected. It's a child. And these are the issues that when you speak with the regulators and said, what is your greatest threat? The greatest threat is that immediately a new bank, especially from the banking regulators, they said, if a new bank will come and do this, so this means these other banks, and I know they are not 7 that they are financially weak, actually is more. My banking system might be able to collapse. So for now, it's more protecting
The incumbents.
exactly the incumbents. Exactly.
Thank you very much to the panel. And unfortunately, I understand that the time is up. If you have any further questions, unfortunately, you'd need to discuss with members of the panel after this session. I'm really sorry that we couldn't take any more questions, but I hope there will be other opportunities, and you can discuss with members of the panel just outside there during the coffee break. But outside that, let's just give the panel a round of applause.
And also a big thank you to Gabriel for moderating, and thanks to all the panel who are also our sponsors. So really appreciate that.